Recording in progress.
And good morning, everybody. It's the day we've all been waiting for. So, yeah, let's go ahead and get started, huh? There's not a whole lot, as you would expect. Everybody is on wait. The statement will come out at 2 o'clock, and then the presser will start at 2:30. We do have crude inventories today at 10:30. It's a normal Wednesday thing. A good thing about that is oftentimes you can get a nice little scalp on, something like USO. The Asian markets are still catching bid. It's interesting, a lot of institutions and firms, funds and managers are saying that China is uninvestable, that you can't trust it right now, that they wouldn't want to put their clients' money over there. And then there are other firms that are saying, oh, what a great opportunity to go over and load up on China names because the state banks were told to buy. And I mean, intuitively, it kind of makes you think, oh, shoot, if the banks are going to buy a lot of it, maybe I should buy some of it and ride it. But it won't necessarily work that way, right? Plus, yeah, I mean, just so, I don't know, right? Probably eventually they will meet the qualifications and classifications and criteria that defines why it is or is not an investable nation. And they are beat down enough. It'd certainly be a nice move back up, but we're talking about, years worth of trading, not some 5-day swing trade. Some of the things to be listening for today is what they consider a pause. So there's 3 different ones that you could think about when it comes to that pause language. One, that they're not going to raise rates anymore. 2, that they're going to decrease the rates. Or 3 would be that they actually start cutting rates. And all of those, I've heard them used in the phrase of a pivot. And mainly, it needs to fit the conversation of whatever you're listening to. Because if you think about it in the sports metaphor, right? If you turn and go the other direction, you pivoted. So if you're talking about raising rates at a standard of 75 basis points at every meeting, and you've been doing that for the last 4 meetings, and then now you don't, well, you've pivoted from your original path, right? So just kind of be careful with the language. If you're reading an article about this after today or, coming up into today, I think everybody's in agreement that he's going to come out 75 basis points. What they're looking for is, will this be the last one on autopilot, or are they going to decrease on the next one to, say, 50 basis points? Keep listening for what they think neutral is. It's been kind of floated that maybe 3% or 3 is a neutral rate, and we're still trying to get into slightly restrictive territory. Well, how do we know if we're in restrictive territory if we don't know where neutral is? We would look at the effects of the economy. We just got really good job numbers, so we're not restrictive enough yet, apparently. So the Fed needs to continue to bring the pain. One or two rallies ago, FOMC meetings ago, the market mistook him. They mistook what he said, and they thought he brought the pivot forward, say into January or February, not January. And we rallied off of that for a few days until they realized that that's not what he was implying. So maybe he'll pull another Jackson Hole moment today and do a mic drop. We'll see. It seems like the more he talks, the more people think he's dovish. So I think he's learned maybe just shut up, say what he's got to say, and drop the mic. It certainly worked at Jackson Hole. So we'll see. Unless the market mistakes what he has to say today, I'm going to stick to my statement from earlier in the week that the current bear market rally is done. It wasn't much of a bear market rally considering what we had, in July and August. But about 200 points, it's not bad. If the market somehow decides that he's dovish, then 41.5 will be the go-to that we'll be aiming for. $4,100 would be the next pivot. All right, we got a lot of auctions today as well. Some in the front end, well, not like the very front end, but 3-year, 10-year, 30-year. All right, we are still holding above that 10-week. Not by much, but we are still holding above the 10-week. Flip that over to a day. You see we're still above the 10-day. We came right into that average range, that average distance from 10, and then we pulled back just like we should, either as a consolidation or as a move back towards the 10. So we're just kind of right on schedule. We also completed our swing, right? If this white line would be, say, the mean or the average, and the swings would come, back and forth from one side to the other. Generally, you get what you give. So, if it's a 2% move or, a 3% move on one side, then you get a 2% move or a 3% move on the other side. So we had our swing low, we had our swing high, kind of topping out. Be looking for our next swing low. Each one of these is supposed to breach the barrier of the previous, right? Lower, lower, lower. It's the very definition of trend. All right, so in the mornings, I talk about this lower indicator. It's a think or swim indicator. It's nothing unique. This is cumulative volume, and it starts at around midnight, and it's just adding up all of the volume that happened in the overnight hours. And what stands out, we know why it's low today, but I'm using today as a great indication of what we would be worried about on any other day. If you come in the morning and you look at the cumulative volume and it's really low, and there's no reason that you know of for it to be low, that should cause you concern, right? We know why it's low today. It's no big deal. It's FOMC day. Everybody's waiting for the announcement. But what if we didn't have any econ on deck and we come in and we see the volume really light? Well, that would tell us that the market is waiting for something, that the market knows something is coming today that's big that they need to wait for, and we need to go find what it is so that we can wait or at least be ready for whatever is going on. It takes a second to look at this indicator because it's either in line and normal or it's not. If it's really extreme or it's really light. So it's just a great opportunity today to point out what we would be concerned about volume-wise if it was any other day but today, right? And it could be job numbers, FOMC, just something on deck that makes the community say, hold on, stand on the sidelines and wait. We are compressed tightly. We made it back down to the weekly pivot point. Been talking about it earlier in the week, how we were maintaining above the weekly, and that's considered to be bullish. And that if we get below it, we would start considering bearish opportunities. Well, we are resting on it, and we have been through most of yesterday and today, just a little bit of crisscross back and forth. But we're also now underneath the daily pivot, so we're trapped in a little bit of a range. And one of the things we learned from the RSI Laguerre is that when a market goes sideways like this, it's actually building up energy. And it's an odd phrase that we wouldn't think about, because most indicators, they use words like inertia and rate of change and momentum. You very rarely hear of an indicator that uses language like energy. But it was a great tool, one, to be able to identify energy, but two, to see the market in a way that we hadn't really seen it before. And one of the ideas behind it is how a market builds energy. Well, if it quickly reverses, even for a small period of time, that will build energy. And or if it goes sideways like this, it will build energy. So when a market is making a move, the movement itself can build energy if it is, say, quickly reversing. And that kind of goes against the conventional wisdom that when markets move, it is using energy, or it's using momentum or trend, or in some form. The analogy that I use is, if I take a ball and I'm throwing it to my son and he doesn't catch it, hits the ground, it lost momentum in the move, right? I was the one that put energy behind it. I threw it. The ball lost energy in the travel and hit the ground. That's completely different than being on a very tall building and dropping a ball. And as the ball travels, it picks up speed. It picks up energy. When we come out of this sideways move today, we are very likely going to have a whole lot of energy. Now, the thing, though, is there's nothing to attach it to directionally, except, you can do things like a squeeze indicator. A squeeze with the histogram bars can often imply a downward squeeze or an upward squeeze. It's not exact, but at least it's giving you a little bit of an implied move. But on a day like this, where the movement is going to be directly connected to an individual who's chipping his teeth live on television, there's no real guess or hedge or way to assume which way this market's going to go. It's just going to be violent. I know a number of people who take today off. They just don't trade. They don't even look at the market. This is a vacation day for a lot of people, just to avoid any kind of FOMO or the urge or the need or the idea to participate in this. We do have a market maker move of nearly 0.75%. Take the 2.4 and the 0.6. We'll just use some rounded numbers. That's a 3% move, and that would be normal. We're talking a 3% move in the S&P would be just a shrug of the shoulders, like, it's nothing, it's just a 3% move, because that's on deck. We would have to actually move more than 3% today to be considered an outsized move. And when you think about moving that far, think about where we are in this weekly expected move indicator. Now, the last FOMC, when we opened on that Wednesday, we actually opened at the same place that we had closed on Friday. That's how the last FOMC started. We're not going to be opening that way this morning, but we are well within our box and our boundaries. 38.11 is the downside edge of this box. And the thing about this box that's useful is that when we get one standard deviation outside of the box, we will activate hedgers, verified, bona fide hedgers. That's literally what they do. It's what they're designed to do. They have permission to do it. And if we're on the downside more than one standard deviation, they will sell into selling. It's really important to grasp this logic. The more we fall, the more futures markets they will sell, because they're trying to get their options trades back to delta neutral. Options have a liquid delta, futures have a hard delta. They will sell futures in a fall to get to delta neutral. But the more futures they sell, the more we fall, which gets them outside of delta neutral, and then they have to sell more. And the more they sell, the more we fall. It's a vicious, vicious loop, and it will end at the end of the week. Thankfully, back in the day, it didn't end at the end of the week because we didn't have weeklies back in the day. So it will end at the end of the week, but it can cause a vicious, vicious loop. Now, if you want to read more about that, when you're on Google, you can go to Google Scholar, you can go to Google Books, right? There's a lot of different places out there, but you would want to type in the search engine things like market maker, gamma dealer, gamma hedgers, market maker hedgers, any kind of phrase or language like that, and you'll find some well-written articles and some good white papers too, some good science research papers that will explain in a lot better detail how volatility control funds and other bona fide hedgers and market makers too will buy into buying if it was a topside breakout more than one SD, or will sell into selling if we go more than one SD to the downside. Just getting slightly out of the box isn't a big deal. It's more of, should we go an entire standard deviation outside of the box? That's where things can get really bad. The 2018 October, November, December timeframe, there was a hurt locker in there where we spent nearly a month of just these wild gyrations stuck in a volatility box. If you're looking for a good example to go back and research. Why bring it up? Well, I mean, we don't really have a whole lot to talk about here. You know, when he reports, it's going to be violent. There won't be a pivot point that matters. Yesterday's high, low, close, today's open. None of them are going to matter. The market's going to move like a mad demon, and there's absolutely no pivot point or any kind of technical analysis that we could lay out to define that. So we may as well look at something else, right? So 4,100 is still the next anticipated leg up if we do maintain this this rally upward. And it is possible. I was actually talking about that last night. Every time I'm listening to Bloomberg or somebody and they start talking in a way that has too much confidence, I get a little nervous. Like when they say, oh, we know the numbers are going to beat today on jobs, or we know that the numbers are going to beat in this. And they don't know. They might have asked 10 different people and got the same answer, and now they think they know, but they don't know. And they've missed before. Their estimates have been wrong. Their consensus has been wrong. And what we've been hearing for, oh, I don't know, 3 weeks is we know we're getting 75 basis points. But do we? So I took the other side of the argument. Not because I think we're not going to get 75 points, but just to take the other side of the argument. And I can see an argument for 50 basis points. I can make an argument for 50 basis points. So it's worth considering, what if the market either misreads Powell or Powell actually comes out a little dovish and we rally. 4,100. If you were to put butterflies at 4,100 right now, I think it would cost you around 10 cents. Now, if we don't rally, you're not getting your money back, but it's 10 cents. You know what I mean? Like, what are you going to lose? You can't even go to McDonald's and get a coffee for 10 cents anymore. And that's $10 for those of you who don't speak options. You're only risking $10. So maybe something to consider today before the announcement. Another one would be some yellows. What if you just buy a couple calls? Well, calls are expensive right now. For the November expiration, the November 18, you're looking at, what, $800 and something dollars? I don't mind buying a gas station lottery ticket, but that's $2. You know, it's $2. I don't mind. I'll get a lottery ticket for $2, not $900. So the idea or the argument would be, take the contrarian point of view, look at other things. If we were to go up today, XLF is going to go up today too. This is 95 cents compared to $900. Or XLK, probably a little more expensive. Yeah, $4, still cheaper. But then we're talking about beta, right? The lower beta names might be a really good way to go, and that would be XLU, XLV. XLV, the liquidity in here is trash. I mean, just absolute trash. So I didn't spend much time looking at XLV, but it does have a beta of less than 1, and it's around 0.7. So lower beta. Or utilities. And I know that these aren't the sexy, glamorous things that we would normally talk about trading, but, you know, XLU, I mean, that's like a triple bottom, but let's just focus on the double bottom for a moment. Investors Business Daily, you know, likes to talk a lot about the idea that a really good double bottom should go lower than the previous low to trap a bunch of traders before popping back up and squeezing those traders and getting a parabolic move. That's a perfect classic double bottom right there. Does that mean we're going to go back up to the top of the channel? Probably not. I don't know. My crystal ball is broken. But if you're looking for some cheap way to play against the consensus, look at other names besides the expensive SPY and the Qs, for the Novembers. Now, of course, if you get up right up into the front, they're really, really cheap anyways, even on SPY and the Qs and that kind of stuff. So it wouldn't necessarily matter, but I don't know. Spending 60 cents versus 460. All right, so today we very likely are going to see an increase in volatility. Pre-FOMC is a volatility dampener. It suppresses volatility before FOMC. And depending on where you're gauging your volatility, it's either going to come from a stock chart or it's going to come from an options chain. In a stock chart, volatility is candle close to candle close. That's movement, which volatility is just another word for movement. So it makes sense that pre-FOMC we see a lack of movement like we have this week. That dampens volatility. So another thing you could think about doing today is trading into the VIX, except from the idea that so has everybody else, and VIX options prices are very expensive, even though the VIX itself is cheap right now, relatively speaking. So maybe sell some VIX, say sell some VIX puts, either as a put credit spread or however you want to sell them, to then go in and use that credit to buy some calls so that you can finance your calls, basically. And the VIX runs on European settled options, so they expire on, technically they expire Wednesday morning, but you can't trade them past Tuesday night, right? It's like a Tuesday night expiry instead of a Friday night expiry. Now on these, going way out of the money in a VIX option, say, not way, I mean, just say 10 points to 35. We would need a significant absolute rip your face off rally for that call to make any money. So if you want those calls to be even remotely salvageable, you're going to have to get them at the money. Just keep in mind, at the money, if you're less than 30 days, then at the money is at the money. But if you start using January, February, March, you're going to have to use the VIX futures to figure out where at the money is. Right? You'll have to go to the December contracts. At the money is 26.12, or January's contracts. At the money is 27.30. So at the money in VIX, if you're not in the front, is whatever these VIX futures are. So if you go out to April, at the money is $28. If you did want to play the front today, say using a 0-day options contract and get something really cheap and really wide, 40-30 in a butterfly as wide as you are comfortable with, dollar-wise, right? Because if you're wrong, you're going to lose every penny of it. There won't be a way to salvage a 0-day butterfly that far out of the money. Heck, it'll even be hard to get filled that far away. But since you're so far away and you're so close to the front, you should be able to widen that thing out a good 25 to 30 points and still keep it really cheap. It's more of a channel than a rising wedge, but I still see a downside breakout of that thing. It'll all come down to Powell. All right. So I'm just kind of looking around at ratios. If you're not familiar with this indicator, the name that you put in first is the dominant name, and the name that you put in second is the secondary name. So if the chart is going down, your second name is strong, and if the chart is going up, your first name is strong. So this is technology versus energy. And in this year, 2022, obviously the market's been going down. Tech sucks. Energy is good. So this price ratio indicator is headed to the downside. We're underneath both averages because energy's been, the dominant sector this year. As we come out of this meeting and more towards the end of the week, we want to see if we break this pivot and head to the downside, which would be a whole new leg in energy. Or if we rebound here and start crossing these moving averages. You can search for this indicator. It's a thinkorswim indicator. Just type in price or type in ratio and it'll show up. So here we've got emerging markets versus developed markets. And same thing, developed markets is the second market. So if we're going down, then developed markets are good. And if we're going up, emerging markets are good. This breakdown here through October and now into November, that was a significant breakdown. Really divergent from what's going on in the marketplace. And we're just starting to turn around and kind of leg back up a little bit. So we're going to be watching this. Emerging markets, with the move we've seen in China in the last few days, it kind of makes sense that we're seeing this because China is still registered as an emerging market, which I call BS, but It is what it is. This would be more of a focus towards those Alibaba, Baidu, JD, PBD, Neo, China names, China ADRs. All right, so we'll go ahead and hit this last bit and wrap up. We're looking at the dollar here. We're still holding that benchmark of 110 on the week. So if we close above 110 on the week, then we don't expect the S&P, to really make expansive moves outside of the volatility that we're going to get from Powell. We're going to just leave that separate because we know he's going to cause volatility today. But we're talking about, kind of beyond that, where we find the dollar on a day-to-day basis is important, but where the dollar closes on the week has a lot to do with things too. If we get down below that 110, we really want to continue to position our swings for the 4100, maybe 41.5. And if we stay below 115, I think we can stay above the year-to-date low. But if we start breaking above 115, then we're going to look to break the year-to-date low and leg down into a new low on the year for the S&P. Still expect yields to stay elevated. But if we break back down below 38, then it's very likely we're going to want to target those upside moves, 4100, 41.5. And if we break above 44, expect a new low on the year. And on a day like this with an FOMC, and there's literally no amount of technical analysis that can prepare us for where the market's going to go. He's either going to flip us over, or we're going to go up like a rocket, and we'll blast right through pivot points. So not a whole lot to cover there. Stock-wise, we're going to be expecting that same thing through the day too. Everything just kind of on pause, holding its breath. Everybody have a good morning, Be careful. Be safe. I'll see you all tomorrow.
Recording.